Right now, markets are behaving as though artificial intelligence can overpower the macro cycle. Equity markets remain near highs, semiconductor stocks continue rallying, hyperscaler earnings remain extraordinarily strong, and increasingly, AI is not just a sector anymore. It's essentially becoming the market itself. But underneath that strength, a different system is emerging, because the AI boom is no longer simply a technology story. Really, it's becoming a capital story, an energy story, a geopolitical story, and increasingly a bond market story. And I think that distinction matters enormously. So markets today are pricing AI abundance, abundant earnings, abundant productivity, and abundant future growth. But the underlying system is increasingly signalling different things: rising financing costs, higher capital intensity, energy constraints, geopolitical fragmentation, and declining policy flexibility. One of the most important signals this week has come actually from bond markets, not from equities. We've seen US 30-year yields move above 5%. UK and Japanese long-end yields continue repricing higher as investors increasingly demand greater compensation for duration risk. Now, historically, in periods of uncertainty, long-duration sovereign bonds would normally rally. But increasingly, bond markets are reacting less to growth concerns and more to inflation persistence, fiscal pressure, industrial policy, and structural financing needs, so rising term premia. So markets are increasingly being concentrated around a small number of AI-linked megacaps, and passive flows from retirement, from CTAs, market cap weighted indices may actually be reinforcing that concentration further. So in other words, markets are increasingly behaving less like traditional discretionary discounting mechanisms and more like mechanically reinforced liquidity systems. Importantly, it's not necessarily a bearish AI framework. The earnings are real. The infrastructure build-out is real. The demand is real. But the key question now is whether the broader macro regime remains compatible with the scale of transformation currently being priced. Because AI still depends on semiconductors, electricity, energy systems, even shipping lanes, physical infrastructure, and global capital markets remaining open and functional. And that means the AI boom is unfolding inside a world increasingly defined by things like strategic rivalry, higher financing costs, energy insecurity, and structural fragmentation. That may become one of the defining investment realities of this regime. Now, these views are mine and not necessarily representative of the Portfolio Construction Forum or any of its affiliates.